reading from the article that is coming. That's what at least one financial expert is saying. Charles Brown of CB3 Financial says,
one of the brilliant moves that Kmart has done is to partnership with Facebook in these e-gift certificates, so you can actually...
Of government mismanagement. Charles Brown is the president of CB3 Financial Group. He joins us this morning from Chicago.
Significantly dropping. Basically, this is the year of the consumer.
Believe that they're capable of managing anything?
Well, it's sort of like handing the keys to the chicken coop to two wolves.
Good evening, everyone, from Chicago. It is Thursday, December 3rd. I'm Charles Brown, Portfolio Manager with CB3 Financial. We are glad you are with us. Took a week off, had a little Thanksgiving there. Hope you guys had a great one. And now we get back to it. Lots going on as we strike out here in December to finish the year. So will this be a December to remember? And the vaccines continue to give us promise that this pandemic is going to be over. I think the timeline is probably Memorial Day, guys. When you read in the news, you know, it's any week now and 100 million doses are being dropped here and there. I think we need to be patient here. I would say if we have a summer, it's clean and that we can get out and do things and go back to normal, that's probably our best case. We'll be phasing in between now and then. So what all we have to do here, those of you that are new online, I see at least a couple, be sure to subscribe to us. Click the little bell so you get notified whenever I go live, which is usually Thursday nights, sometimes Mondays, and sometimes other times when there's breaking news. Also, be sure to follow us on Twitter. I tweet every single day, sometimes more than once a day. And we could be having some announcements here, as far as the election goes. So watch for that. You can also follow us on Facebook and LinkedIn. Corona America, what is going on? Guys, I show this screen every single week, really since March 12th when I first started doing this program. And this is not a good week. 200,000 new cases yesterday. And obviously some of this is because there's extensive testing going on. All right, but the 3,100 deaths, the charts I've been showing you here usually are under 1,000, but we're seeing a bump up here. Certainly there is either a second or third wave in progress. How much of this is tied to the seasonal change here in the north, where obviously the virus does better in cold weather than hot weather, although really still pretty bad over the summer. But just be aware. Keep your masks on, stay away from huge crowds, and just keep washing your hands. I always hear the wear your mask and stay away from large crowds, but just keep the cleanliness thing going. I think that's going to be a takeaway from this pandemic. Obviously, this is affecting consumer confidence. We saw the huge plummet in April. It's slowly been rising, getting back to at least trying to get back to normal here, about a third of the way back to the highs we saw in March. But these last 2 weeks have been a little bit of a dip. I don't expect this to continue. I do hope the holiday cheer is going to perk up Americans. And if we can just see some pretty good sales numbers. I mean, we know the pandemic is terrible. And at least here in Chicago, we did have a jet land with some of the first vaccines. And we'll see if that can get the consumer confidence a little bit higher. Pfizer and Moderna, as you know from previous episodes here, are the ones in this tight race. AstraZeneca is also in this. Theirs is a little bit different in that it is for the elderly, and I guess I would include myself in that group. So it's for the 65 plus crowd, whereas Moderna and Pfizer are for the more average age of Americans was somewhere in the 40s. So these are rolling out, and it's first that has to get FDA approval, and second it has to be manufactured, and third it has to be distributed. So the UK actually becomes the first country to authorize Pfizer, the Pfizer-BioNTech vaccine for emergency use. shown to offer 95% protection against COVID-19. Guys, that's a great number. Normally when these are announced, it's somewhere in the 70s to low 80s. This is a fantastic number, that 95%. And we certainly hope that efficacy rate is going to prove to be true, and we'll know once the vaccines have been administered. Confirmed cases, so this trajectory is one that's about a week old now, and even it is, you see the little bump there in the dotted line and then the retreat. It's going to be, I think, probably well into January before we start seeing cases go back down again, simply because it's that time of year when people congregate, they're together, and if someone in that group is infected, and of course we're inside now, at least here we are in the north, there's really no way to get around it. It's just, as I've said earlier, we like the numbers heading down on the deaths. We got a big spike these last few days, but in general, the death rate of 1.5% is still pretty accurate. Obviously, 1.5% on hundreds and thousands of people and millions of people worldwide is higher than we want it, but it certainly beats the 12% from the Spanish flu from 100 years ago. So we keep talking about recovery here, the U-shape, the V-shape. What does all this mean? Well, I wanted to talk about this a little bit tonight and just present this video that goes into the details on that. I've discussed why I think this is a V-shaped recovery. However, a V-shaped recovery in the stock market does not necessarily mean that we're going to have a V-shaped recovery in the actual economy.
If you watch the news, you've probably been hearing about alphabet economics.
V-shape.
That V-shape.
The W shape, the U shape, or the dreaded L shape.
This is how economists talk about economic recoveries. And it's not just jargon. These letters drive policy decisions at Congress and the central bank. Decisions that can help determine how far we fall and how quickly we rebound. But the coronavirus downturn is different from past recessions. In fact, it's so different that economists are having to come up with new shapes to describe the potential recovery. When economists study a rebound, they often look back at previous recoveries for insight. Here's a look at change in the U.S.'s gross domestic product over the past century. You can see, these letters appear in different places on the chart. Look at 1953. In the midst of an economic boom, the Fed raised interest rates to prevent inflation, and the economy saw a sharp contraction, followed by a quick recovery in 1954. This is the V.
V is preferable. What it means is that right after you have the downturn, you bounce right back. In a V-shaped recovery, we would get back to the previous high of GDP and the previous low of unemployment within a matter of months instead of a matter of years.
Experts say it's possible that we could see a V-shaped recovery from the current recession.
The early signs that we got in May suggested we were bouncing back from a very deep hole. There's a chance people just come back and try to get back to business. Some of their income has been replaced by the government, by government paychecks, and so they could come right back, but it's not a certainty.
Jump ahead to the early 1980s when the Fed pushed interest rates higher to battle inflation. The GDP dipped down in 1980, spiked back up, and then plummeted even further before recovering at the end of 1982. You can see this formed a W-shaped recovery.
The Fed was pushing up interest rates to get inflation down, but it didn't work. They had to go back at it. And it wasn't really until the end of 1982 when the Fed was in a position where it could cut interest rates aggressively and get the economy back on track again. The Fed is in a different position this time because they've cut interest rates very aggressively already. There's no inflation on the horizon.
If we see a W this time, it will likely be for different reasons tied to the coronavirus.
If the second wave comes in and people stop going out and factories have to shut down again and governments start, putting on more restrictions, that could stall the expansion that we started to see in May and June.
But there are other options too. Look at 2009, at the period following the last financial crisis. The economy declined steeply when the housing bubble burst and took nearly 2 years to recover. This is known as a U-shaped recovery.
What could cause a U-shaped recovery this time is you have to come back to the coronavirus. If we continue to see high caseloads and high hospitalization rates, it might be that people are very slow to get back to business normally and that we just don't climb out of this very quickly.
So those are the traditional shapes of alphabet economics. But again, this downturn is different, and economists are looking at other shapes to try to describe it.
Our economy got hit by an outside shock, the coronavirus, and we just shut it down. It was almost like a meteor hit the economy.
One of these shapes is the swoosh, where the economy falls quickly, rebounds a little, but then takes months or even years to recover fully.
I think what would cause a swoosh-like expansion is that all the uncertainty that comes out of what we just experienced, the way people think about, for instance, do I want to live in a city anymore? The way a business thinks about, do I want to invest in an urban area or someplace where it might be safer and not as congregated, that it takes years potentially for people to get back into a comfort zone where the economy is functioning at its full capacity.
And it may take even longer than that. Some economists say this recovery could look more like a reverse square root sign, where it drops and then rebounds partially before flatlining for a prolonged period of time. If you look at the Economic Activity Index from earlier this year, you can kind of see it. It dropped sharply in March and rebounded partially before appearing to start to flatten out. But it's too soon to say if it will flatline.
I would say a reverse square root sign would mean in the early stages of the recovery, a quick bounce back. And we have seen that in May and June. But then as it proceeds, it flattens out. So we don't get all the way back to where we were because businesses and households come out of this less willing to spend and invest because the coronavirus doesn't go away.
The path of a recovery isn't just an abstract shape. It helps policymakers determine how much stimulus money to pump into the economy.
If the Fed was confident that we were going to have a V-shaped recovery, then they would start raising interest rates sooner than they otherwise would. They would stop doing their bond buying programs sooner than they otherwise would. If they think it's going to be a long and slow and drawn out recovery that holds down inflation, then they're going to keep interest rates really low for a longer period of time. It's fundamentally important because if the Fed is determined to hold down interest rates because it thinks it's going to be a slow recovery, then that will hold down the rate that you pay on your mortgage. That'll hold down the rate that you pay for a car loan.
To protect millions of unemployed Americans, the Fed has signaled plans to keep interest rates close to zero through 2022.
The worst casualty economically in a recession is the person who loses his or her job. And so this affects everyone who's out of work and wants to get back on the factory floor, wants to get back into the restaurant, wants to get back in the office.
Congress's decision about whether to approve more economic relief for these workers will depend on the shape of the recovery. And as the coronavirus cases rise across the country, that shape remains uncertain.
So as we've talked about, there's really two economies going on here, and that's why there's two markets going on here. There's a bull market, there's a bear market. Depending on which industry in which you are employed, you could be seeing an exceptionally good year. I know real estate people, for instance, that are having a tremendous year. And again, it depends on which part of the country you're in. But then other people in other industries that are really, really hurting. And we have not seen this sort of diametrically opposed economic reality, at least any time since I've been doing this over 30 years. So let's get to our first question of the night. Did COVID-19 change any of your lifestyle this year? And I know we're on about a 25-second delay. So the answer number one for A is yes, my vocational industry had a big hit that affected my paycheck. B is yes, I was unable to enjoy friends and, let's try this again, family and friends. C, yes, my dining out, entertainment, and shopping was affected. Or D, no, really not too much change. And some of you may have more than one answer. Feel free to do A and C or whatever. Keith, we got a C. Yeah, no kidding. I'm going to put myself in C there. Actually, C and D, because for me, vocationally, it really wasn't that different. But for a lot of people, it was. And AJ, yeah, I can imagine big hit as far as people moving different parts of the country. Hey, Charles, good to see you, sir. Yeah, no real change. Well, you're blessed to be in Florida with one of the very best governors in the country, in my opinion. Tom and LG got a B. We got a B for the Walls. Dr. J, B and C. K, B and C. Yeah. It's really affected all of us in some way or fashion. Even if not directly, it's affected us because we know someone whose lifestyle dramatically changed, or very, very significantly here in 2020. So where are we in the economy? The U.S. economy, the NASDAQ, 38% on the years, guy. The S&P up 13.5%. The Dow only up 5%. The Russell about 11%. I just saw Tommy's answer, A, B, and C. Yeah, it was multiple choice on this one, guys. If you guys remember, though, this chart was in the red big time when I first started doing these. My first episode was March 12th. And, it's back to all green, which is, frankly, a miracle. We are still technically in a recession until we get the final GDP numbers for the fourth quarter. And we are still definitely in a pandemic, certainly, from the charts that I showed you first off. Our growth program, as you guys know, some of you on the line are my clients. Some of you are just interested people, and that's great. We're glad to have you here. But our growth program up 55% this year, actually a little bit higher because I didn't include today's results. Really pleased with that. And then our what we call DG, diversified growth, much more conservative even there. Let's go back, up 21%. So it's been a really good year. And if you are a client and you were wondering how you're doing, as you well know, I trade in our family and our trust and IRA accounts, all the programs that we offer here at CB3 Financial. So how I'm doing should be how you're doing if you've been with us the whole year. If you came in mid-year, then obviously your performance will vary. If you're watching tonight and you don't have an account with us and you're interested, just give me a call. The contact information's there at the end of the program. Why are we having such a great year? These stocks right here: Apple, Microsoft, Amazon, Alphabet, Facebook, Tesla, Visa. We don't have Berkshire, Walmart, Johnson & Johnson. Every one of these mega cap stocks has been or is still a part of our programs this year. These have been the huge winners simply because investors were making the statement that, look, if it's getting scary out there, I'm putting my money with these mega cap companies that are best able to withstand a major downturn in the economy. And then you have the upstarts like Zoom and Peloton. I know trainers are out there thinking, wow, this Peloton thing is, maybe competing with me. But actually, Peloton has a whole different market. So we see people being very conscious of wanting to be physically fit because we're all locked in our homes now. So Peloton's a part of that. Private trainers, pretty much doing pretty well too. Look at the NASDAQ. I just said the NASDAQ is killing the other indices, but look how it is versus these two stocks. We're in both of these, by the way. That's what we do at CB3. We're looking for the outperformers, and we use the NASDAQ as our internal benchmark, even though we show you guys the S&P. Why? Because the NASDAQ is a tougher benchmark to beat. And so just to drive ourselves harder, we make sure that we're beating the NASDAQ. At least we're trying to. So the unloved indice this year has been the Dow, but finally it made it over 30,000. Why is this important? I think it's important because the Dow is the indice that is the oldest. It's the one that's probably the best known with the general public. But it's important to realize that all asset classes, those high-tech companies in the NASDAQ, the S&P 500, the small cap in the Russell, and then the old industries, if you will, that are in the Dow, all those asset classes have to continue to perform well if we're going to continue in a secular bull market. So let's see how that looks now that the Dow is at least catching up to the industry-leading NASDAQ.
The Dow Jones Industrial Average just hit 30K for the first time since its inception in 1896. After a long rally, the Dow surged to this milestone as investors cheered breakthroughs in 3 separate COVID-19 vaccines, offering hope the economy may soon get back to normal. It also followed Democrat Joe Biden's victory in the presidential election and the General Services Administration clearing the way for the president-elect's transition process, easing investors' concerns about a drawn-out period of uncertainty. This latest stock market rise was driven by stimulus programs from the Fed and leadership from tech stocks.
The speed of the climb from 20,000 to 30,000 has still been astounding despite what we saw earlier in the year, which was a huge sell-off in February and March. It took about 18 years for the Dow to get from 10,000 to 20,000, and it's been less than 4 years for the Dow to climb from 20,000 to 30,000.
The new high comes around 9 months after the Dow plummeted from investors fearing the economic impacts of the coronavirus. During this period of historic volatility, on several occasions the Dow fell more than 3% in a single day. After reaching its February 12th peak, the blue chip index fell nearly 40% in just 6 weeks, hitting its lowest closing level since 2016. When it comes to the Dow, milestones like 30,000 serve as an indicator of how well shares of a select group of large technology companies have done. And in that regard, the biggest contributor to the Dow's rally, Apple, underscores the influence of the tech sector on the global economy during the pandemic. More on the Dow's other leaders and laggards in a moment. But first, let's take a look at how the index works.
The Dow looks a lot different today than it did in 1896 when it was first created with 12 smokestack companies. So these were companies like Tennessee Coal and Iron, General Electric, that were old economy companies. Today, the index has 30 stocks that are weighted by stock price, and we've seen tech companies like Apple and Microsoft, and more recently, Salesforce really have a big influence.
Editors at the Wall Street Journal help select the 30 companies that make up the Dow. Those stocks are generally seen by investors as the pillars of the stock market. When it comes to the Dow, the more expensive the stock, the more pull a company has. So a 2% stock price gain by United Health would add more points to the Dow than, say, a 2% gain by Cisco. Its stock price is a fraction of United Health's.
Other stock indexes like the S&P 500 are very different from the Dow because they weight companies by market capitalization. So companies with the biggest market values like Apple will have a much bigger influence on the S&P 500 than they do on the Dow.
That means just a handful of stocks have driven up the value of the Dow over the last few years. Take Boeing, for example. Before two deadly crashes, the grounding of the 737 MAX fleet, and the pandemic, the aerospace company was driving the Dow's gains. More recently, tech companies like Apple and Microsoft have taken the baton from Boeing and overshadowed the declines in shares of former market leaders ExxonMobil, IBM, and GE. While recently the coronavirus crisis has been a driving factor in the success of certain companies and the travails of others, political factors have long played a critical role in moving markets.
The wealthy are paying a fair share of taxes, even as the stock market shatters records.
Our stock market has reached an all-time high today.
2017 was a pretty good year for the stock market. The world's major economies were growing in sync, corporate profits were rising, and the Dow continued to steadily climb higher. In November, the release of the GOP's tax cut plan would have a direct impact on those 30 companies that make up the Dow.
With this plan, we are making pro-growth reforms so that, yes, America can compete with the rest of the world.
Investors considered the tax cuts good for big business.
The Dow is moved day to day by the same factors that influence the broader stock market. These could be economic indicators, political questions, or recently momentum signals.
2018 was full of uncertainty. There were trade tensions with China that threatened globalized businesses' bottom line.
In particular with China, we're going to be doing a Section 301 trade action. It could be about $60 billion, but that's really just a fraction of what we're talking about.
And President Trump criticized the Federal Reserve for a dip in the markets.
I think the Fed has gone crazy.
In 2019, the Fed cut interest rates for the first time since the financial crisis. Not just once, but 3 times.
Today, we decided to lower the interest rates for the 3rd time this year.
Other central banks around the world took actions to stabilize their economies as well. And towards the end of 2019, some progress was made after months of trade talks between the U.S. and China. President Trump agreed to a limited deal with Beijing, dropping threatened tariffs as China agreed to purchase more goods from the U.S. By January of 2020, the president had signed the first phase of a trade agreement. And the Dow, in the early months of the year, with GDP and unemployment numbers strong, continued its steady march toward 30K. In mid-February, amidst the profound economic uncertainties of a global pandemic and the widespread shutdowns in March, the Dow, like all major world indices, witnessed a historic sell-off. But then, from early April onward, investors found hope in multi-trillion-dollar federal relief packages, the Federal Reserve's aggressive stimulus programs, and growing optimism that a vaccine is on the way. In addition to Apple, shares of Microsoft, Amazon, Google parent Alphabet, and Facebook have soared as the pandemic and trends like remote working and learning bolster consumers' reliance on new technology. For the S&P 500 and the tech-laden Nasdaq, these companies have more than compensated for the declines in economically sensitive sectors like energy. While many analysts are wary of a reversal following such a strong rally, investors say the fundamental drivers of the run are still intact, particularly for tech companies, whose growth is even more appealing in a world with ultra-low interest rates.
Who knows where stocks will go from here? The coronavirus has really introduced a whole new level of uncertainty in both directions. Investors have really been staggered by how quickly stocks fell earlier in the year and how quickly they've since recovered and how fast the Dow is now at 30K. So who knows? Each 10,000 points gets easier, so 40K might not be out of the question.
So I've told you guys over time that we don't necessarily want to be in every sector. There are 11 sectors, and just seeing the chart on the screen where they talk about certain stocks actually exceeding the performance of the really bad stocks, and that's why the Dow is higher. There still were percentage-wise more losers in the Dow than there were in the Nasdaq, which is why the Dow has lagged the Nasdaq. So as your money manager, what we're always looking for are where is big money on Wall Street buying. We're never going to compete with them. We're going to coattail them. And in fact, my ability as a portfolio manager to coattail the smartest minds on Wall Street really is a measurement of my success and others that do what I do. So you guys understand, I know what the political impacts are on the market, at least how they can be affected. You saw that in this video. Let's look at some economic data. We cover this every week. We just had this, the first video on the V-shaped recovery versus U-shape or whatever. You can clearly see a V-shape here in personal income spending and how it's such a dramatic return to normal versus the 2008 recession. This is a positive, but it's only one aspect of the recovery. Looking at Tesla, I'm actually trade overseas right now, just under $600 overseas. We bought Tesla at $158, and I have had several clients say, why aren't we taking profits? Gosh, this thing can't just keep going up. Well, yeah, it can keep going up. And in fact, we want stocks that turn into what they call 1-baggers, 2-baggers, 5-baggers. Peter Lynch was looking for 10-baggers. In other words, a stock he bought for $20 that went to $200. Tesla has been one of these. Zoom has been one of these. Peloton, I've shown you some of these. That's what we're looking for. Tesla, I believe, is the next Apple. You saw on the chart earlier, just what it's done, and it's pretty amazing. We've been talking about it, over the, the last 20 or 30 weeks here. We've been doing this. So here's something I want to pause and just talk about for a minute. So this setback to the big cities. What happens when employees just simply don't come back to work? Well, that means there's an exodus. So look at this exodus from Manhattan and Brooklyn. You put those two together, since they're both just boroughs of New York City, and then you have Chicago, San Francisco. I don't get the Naples. We've got some Florida people on here. Maybe you guys can suggest to me why there's an exodus from Naples, Florida. I would think it would be just the opposite. But every other city on this map has an exodus problem, and it's because Americans have realized, one, it's more dangerous health-wise to be in an urban area, and two, it's not as necessary as we thought, as long as you've got a broadband internet connection. And of course, that's just essential. It always has been, at least the last 5 to 8 years, but it's even more so now. What do I think this means for the future? And of course, I'm going to be watching this trend. If the cities shrink in population, and I believe the greater Chicago area where I am, a little over 9 million people in the metro area, the 6 counties that are here, I think that will easily drop to 7.5 million over the next 2 years as people leave and decide they can make a living elsewhere. Just to give you one example, when GM closed a factory in Lordstown, Ohio recently, meaning this year, where did all the workers go? Do you see any of those heading north or east? They're all going south. We are seeing a tremendous exodus from the northern, what they used to call the Rust Belt, to places like Texas, Florida, Nashville. I have a definite experience about the exodus to Nashville. Atlanta, South Carolina, we're seeing people move. And what does this mean beyond just a geographic location? It means that the city's influence from a political perspective could be changing 4 years from now, or certainly 8 years from now. And how does that affect us? Because that can affect spending patterns, and we want to be where the money is flowing, and that's how we invest. So just a little bit of education there on how that works. One of the items that I'm going to be studying here, the 4 reasons the stay-at-home economy is here to stay. This was really too much for me to present tonight. I may present it next week, or I may just study it, over the Christmas period here, and give you a detail on this, because we really need to nail this as portfolio managers, because the stay-at-home economy affects airlines, restaurants, but definitely airlines, hotels, office buildings, commercial real estate, lots of things in play here. And this trend, which has begun in 2020, either will slow down or accelerate in 2021, and we'll be watching that with you. I continue to get, I should never have told you guys we're going to have a webinar on Bitcoin. That's really not fair, because I'm excited about it. I need to be candid with you. Brand new all-time high, just under 20,000. Actual futures contracts traded higher than that. But people think, well, it's, Bitcoin's doing so great. Actually, Bitcoin is one of the top 3 coins, Ether, also known as Ethereum, and XRP, also known as Ripple, actually outperformed Bitcoin. So, and I don't know if my friend Mark is watching, but my friend Mark introduced me to crypto trading just a couple months ago, guys. Just actually in early September. I started with 50 grand. And, I always present my actual statements on screen because I want you to know whatever I'm going to recommend for my customers. And I'm not recommending right now that you trade it. We had one day where we were down 22% in late November. So why is this important? Because digital currencies are a very possible, and I'm going to suggest probable, replacement for what we call fiat currencies. The problem with a fiat currency, and again, this is how we get affected as investors, is that the Federal Reserve can print money. The Bank of England can print money. The Bank of Canada can print money. And when these various federal entities start competing with each other, there's nothing to inhibit them from printing all they want, which does what? It actually reduces what our dollars in our pocket are worth. A digital currency that has limited issuance, there are only 21 million Bitcoins, for instance, means that you can't dilute the value of your coin by printing more digital coins. We'll get into this in January. I know you guys are interested, at least some of you have. Actually, one of my clients actually sent me an account and said, hey, I just got started here. What do you think? And I said, well, sure. So we know this is an important topic for 2021. All right, we'll get on it. Industrial production. This is another one of these V-shaped charts. You can see the longer time frame that it took in 2008. But just really looking good for 2020. We're obviously are not back to the 100% line where we were in early February, but definitely moving in the right direction. Personal consumption, same routine. A much bigger drop here, but in 2008. In other words, people kept spending in 2008. It's just their stock accounts went down. But the recovery actually exceeded, the 8-month period. We're about 8 months into this now, 9 months. So that's another good data point. This is something I know we have some users that are F-150. It's the most popular automobile or motorized vehicle, I believe, in the world, but it's a truck. Look at here, truck orders in November 2020, right at the lifetime high of 2018. You can say demand's falling away, guys, but there are certain industries, and there are beginning to be more and more industries and parts of the economy that are recovering. And that's what I bring you every week on this program, because I want to encourage you. Yes, we have been through and are still going through a terrible pandemic, but data points like this, I've never shown you this one before, are what I think are real encouraging. Mortgage, talking too fast, guys. Mortgage Purchase Application Index. All this means is people applying for new mortgages, okay? And I can tell you from at least two friends in the real estate market in two different cities, two different states, that markets are unbelievably hot right now in the South and even in the North, more so in the South, obviously. But this is a good trend. Again, in a pandemic, in a recession, seeing these numbers going up. Residential construction, again, I can tell you my recent trips to Wisconsin, New Hampshire, Texas, and Nashville. The cranes are out there, guys. They're just building like crazy. Residential property, not commercial property. I'm not seeing that anywhere nearly as prolific as I'm seeing residential building. This is a chart I've shown you many times that seasonally we see pending home sales drop off. You can look at the previous years, see if a chart's going down. What do you see for 2020? A huge spike in April and May when the Fed lowered the rates. You mentioned Jay Powell in the video. We're back to 0%, 0.25. Actually, it's a spread on the Fed funds rate. And that's what's happened. We're still seeing strong pending home sales even as we head into December. It's a really good sign. Another study that I'm going to do, why working from home will stick. I really want to understand this. I think it's important for me as a portfolio manager to manage your money, or if you're watching and you're not a client, just to educate you. This is a huge trajectory change in America, and we don't really know how pervasive it's going to be and how many industries and to what extent it's going to affect those industries. So this is something I'm going to be studying really for the whole first quarter. So special webinars could be in your future here, other than my weekly program, in both the cryptocurrency space and this working from home space. So if that's something that interests you, I hope you'll tune in when we do that. I always finish this section with this chart. This is the S&P 500 and the percentage of stocks that are beating expectations. As you can see in yellow, 494 of the S&P 500 stocks have reported, just a handful left. 84% have beat their expected earnings. That is a phenomenal number. Why? Their normal number on average over the last, 18 years or so has been about 73%. All right, you only have 3% matching, 12% below expectations, 84% beating those expectations. I am really encouraged, again, in a pandemic, in a recession. You could argue that the bar was set low, but the truth is, they're meeting the expectations, and enough industries are doing it that they're pulling up those industries and market spaces that are not doing as well. You saw that in the video, the second video that I showed. So it's time for the second question here. What do we got? So I think the stock market is going to calm down after the Electoral College Day, that's December 14th, calm down after Inauguration Day, that's January 20th. Stay edgy into first quarter of 21, or stay edgy for quite some time. We got that 20-second delay here, so I'll let you guys answer this, and I'll look over in the chat, see if there's anything I need to respond to. All right. Appreciate you guys watching this here. I think actually I got all of these earlier. Light at the end of the tunnel, Larry, I appreciate you mentioning that. Yeah, I think we're getting there on the political scene too. I'll get to that in the next segment, obviously. All right, starting to get some answers here. D, stay edgy for quite some time, Charles. Dr. J, calm down after the Electoral College. I think so too. I think President Trump, at least in his most recent press conference, is indicating, I think he still believes he's going to win, but he has said that if he doesn't, he intends to be the next Grover Cleveland. If you don't know what I mean by that, Google it, please. C and C for Tom, for Keith, B. Got a B, a C for Mark. Okay, stay edgy. Guys, we'll see. I know that during the course of this year, at least 25, I won't say a third, but 25% of our clients at one point said to me, gosh, should we just take some to cash and like maybe 25, 30%? I'm going, well, you can, I'll do it. You know, I work for you, but I'm not going to. I've been fully invested this year and actually leveraged, meaning on margin in some aspects since September, which I do not do for you. But in my own personal trading, that is how bullish I am. And the reason is this. I believe we're in a secular bull market. If this is your first time watching, I'll give you that background probably next year when we, I'll go through that whole deal again. But those of you who have been watching know my thesis and my support reasoning for the secular bull market. So if you're new tonight, go back and watch those videos. Hey there, Charlie. How are you, sir? Got a C on staying edgy? Yeah, okay. Well, guys, we got a lot of edginess here. Let's see what we got going forward. So the 2020 election, about 2/3 of Trump voters don't accept the result. Surprisingly, 3% of the Biden voters don't accept the result. Now, I don't know who those 3% are or what orbit they're in, but mostly the Biden voters think everything's fine. 2/3 of the Trump voters don't agree with it, but a third do. So the challenges saying, there's voter fraud extensive, it's not like those two circles are inverted, and that's why I put this on the screen. Many believe that, yeah, he did lose, although the preponderance, 62%, do not think it was fair. And those same people have a profound mistrust of the election process. Only 12% of the Biden voters think that there was voting fraud. 79% of the Trump voters think that the election was stolen. That was the actual question asked. So it's interesting to me, though. This is a really cool questionnaire from Politico. Who is the best champion of the GOP? Are voters really dissatisfied with Trump, or do they think more of Congress? Well, the heavy red here, or the crimson color there, is thinking that Trump is more effective, and the pink is thinking that Congress is more effective, and the middle gray part is just clueless. But in every category, Republican voters think more of President Trump than they do of Congress. And I just find that fascinating. We picked up, that was a slip, wasn't it? The Republicans picked up 11 seats in the House. Nancy Pelosi has a very, very narrow lead in the House this year, and it's going to be weakening power. If the 2 seats in Georgia stay in Republican hands, the Republicans will only have lost 1 seat, so there'll be 52-48. And then, of course, the presidency likely, certainly at this point, will be held by the Democrat Party. I want to remind you guys, I've shown this every week for 4 weeks, but for those of you that haven't seen it, what happens in the S&P 500, that SPX stands for S&P 500, if there's a Republican in the White House versus a Democrat in the White House? Well, in the first 3 months, it's better for the market for Republicans. And then from then on, it's better under a Democrat presidency. Now, the exception to that was the Trump presidency from 17 through now, what will be January 19th. Of next year. But if you're concerned that the market's just going to go crazy to the downside, the market can't, like when the Electoral College votes that you got to get out because then it'll be official that Biden's the president. It's just not going to happen. It's just no indication of that in the historical data here. And certainly if my premise of the secular bear market or secular bull market is accurate. All right, so I've asked this, a couple times, but I've changed the dates now. Who will win the 2020 presidential election? Donald Trump by the 14th, which is the day of the Electoral College. Joe Biden by the 14th. Donald Trump after the 14th. In other words, will the Supreme Court stay the voting of the Electoral College for 1 or 2 weeks to allow some of these court cases to go through and actually force the 6 key states, you guys know what they are, to rescind their certification of the vote. That could happen. That's certainly what the Trump administration is hoping for. But that's why I have this question up here. So let me know what your vote is. Donald Trump after December 14th for Keith. Okay, that is, yeah, that's a brave answer. Okay, Mark Burns, we got to see. Okay, I see you on Stop the Steal, Charles. I definitely see you on that. Tom, Joe Biden by the 14th. Okay, Kay, looks like Kay, you think he's going to win? I see you, Charles. I may do this poll one more week, but we got to see some, we have to see, America needs to see evidence presented to a court. We can't conduct this analysis here in the media. We just can't do it. So I'm encouraged that the market has been as resilient as it's been, even with, it seems like, just an unending amount of chaos. And the market still holds in here. That is why I'm such a fervent believer in a secular bull market. I'm looking at the votes here. E, Joe Biden currently has. Okay, baby. Okay, B, is this a trick question? No, it's really not supposed to be a trick question. Deb, and the reason for that is because by December 14th, if the Electoral College actually meets on the 14th, the Supreme Court could order that deferred. They can't go past January 20th. That's in the Constitution. But they can delay the Electoral College voting. Okay, so that could happen. Charlie, answer A. I think you're the only A on here. Donald Trump by December 14th. Okay. All right, guys, I think I've answered all of you there. Just reminding you, those of you that are new, please do subscribe to us, okay? Lots of good data, and tell your friends. Please tell your friends. We like this community. We have a good time here on Thursday nights. Hit the subscribe button, hit the bell so you get the notifications. Be sure and follow me on Twitter for late breaking news, especially over the Christmas break. My contact info, if you guys want to talk about those portfolios, those of you that are not clients, I am really low pressure. You can email me, you can call me, whatever you want to do. Glad to talk to you about how we're getting these results. That is what I do for a living, but I also educate. And it's really important to me that each of you on here, whether you're a client or not, understands fully what I'm talking about and how it affects you and your financial future, okay? I always end with this from 2 Timothy 1:7, for we have not been given a spirit of fear, but a spirit of power, love, and a sound mind. It remains my deeply held belief that we will not only survive this pandemic, the election, and 2020 in general, certainly the most tumultuous year that I can remember in my life. We will not only survive it, we will emerge a stronger people and a stronger nation. Guys, that's our show here for Thursday, December 3rd. Be sure to be here a week from tonight when I have a major announcement to make to all of you. Some of you on this call already know about this announcement. Some of you, it'll be a big surprise. It's a good thing. I'm excited about it. I'm really excited about 2021. I'm wishing you guys just stay safe, enjoy the holidays, go out and buy a real tree. Did you guys see the stats on this? Real trees are up like 320%. Because people are just trying to have some kind of normalcy, all right? Buy a real tree, decorate it, bring your kids around, grandkids around, take care of yourselves. I'll be back here next week. Please remember that at CB3 Financial, we don't just manage your assets, we become one of them. From COVID to politics to finances to clarity. This is CB3 Live.